Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Thank you for tuning in. If you have not already, hit that subscribe button. YouTube, BitChute, SoundCloud, whatever platform you're on. We're so fortunate to have Matthias Weber, and don't ask me how to pronounce these names. I hope that is correct in English. He is an assistant professor at the University of St. Gallen, which is a top university and particularly focused on economics and finance in Switzerland. And you can follow him on Twitter, LinkedIn, and he has written a somewhat novel or an academic article that really pushes the boundaries a little bit and is not so boring. So I'm excited to explore this. Matthias, please tell us how to pronounce your name, and thank you for coming on the show.
Thanks very much for having me on the show. So it's pronounced Matthias Weber, so you were pretty close.
Matthias Weber, beautiful. Okay, now I am holding this one up here. Actually, I'm not sure if this is going to work, but I was making some notes. And the title is Experience Does Not Eliminate Bubbles, Experimental Evidence. And this is a fascinating topic. Like, it just seems like bubbles are just part of the furniture of the financial sector. And you would all think, don't we learn from experience? Are humans just so tribal or herd-like? What is going on? So your paper addressed the notion that we perhaps do learn from experience, but you're saying that no, we don't. Do you want to clarify what you're addressing and the implications?
Yeah, of course. So you rightly say bubbles are very natural in financial markets, or I think rightly, but I mean, in the real world, it's quite hard to quantify what a bubble is ex ante, right? So that's why you even have people like Eugene Fama who say, well, it's not really clear what this is. I mean, you cannot quantify this ex ante. You don't know the fundamentals. And it's true that you cannot observe the fundamentals, right? So, I mean, a lot of what could be in the price might be expectations that are justified or not. And if you just say afterwards, well, it turns out these expectations were not justified, this doesn't mean that you can really say while the bubble is going on that it is a bubble. And that's an advantage of experimental work, right? That in experimental work, you can really observe fundamental values. You know what they are. You can really talk about what bubbles are. And that's why you have a lot of this experimental work on financial asset markets, on bubble formation. And what you have in a lot of these works is that, well, these bubbles, they arise all the time. I mean, you do this, you set up such an asset market in the laboratory and you get these bubbles. But then you repeat this, you do it over and over. And after already a couple of times, these bubbles disappear. And what we are showing is that this is a bit due to the fact that there is not enough cash in the economy, basically cash in these markets. So what we show is that these bubbles don't disappear if there is enough cash around, if the participants have enough money to buy these assets at higher prices. So even after they've spent some money to buy the first assets, that if they can continue to buy, if they have the cash available, we have these recurring bubbles.
Yeah, there's a lot to unpack there. And just for people who are not familiar, Eugene Fama is one of the most notable living academics in finance, and based at the Chicago Booth School of Business at the University of Chicago. And he's famous for the Fama French model. And there's a long story to him, and that he was such a star that they didn't let him leave when he got his PhD. He just stayed there. But so he is right there that defining when there is and is not a bubble is a tricky task. So, but we do observe maybe convulsions. And so I guess the people who would say they're not bubbles, they're just saying that the fundamental information has just changed, right? We've just learned new information, which is destabilizing, but it's really just responding to new information. Now, the other point you make is that a lot of the experimental evidence in the past has been based on, as you said, a low cash to equity ratio, if I'm characterizing correctly. And you say
low cash to asset ratio, yeah.
Cash to asset, yeah. And the challenge is that in real life, a very small proportion of actual assets are in equities. So therefore, a more realistic picture is what you've sought to go for, to have a higher cash to asset or equity ratio. Okay, let's try to back up here. So you've basically run a couple of experiments or different experiments testing people's response, or they're almost playing a game, and they have all the fundamental information available. So you basically, it's more perfect, or should be more perfect than the real world, and yet people still stray. Do you want to clarify?
Right. So, I mean, in the end, participants have much more information about fundamental values than anyone in the real world would ever have, right? So it's really, it should not be difficult at all for the participants to price the assets correctly, right? They have all the information available. The calculations are not very hard. So, I mean, anyone, a 12-year-old could do the calculations to get to the fundamental price. And still, we do see these bubbles. So we do see buying at and selling at very high prices at a multiple of the fundamental value, if there is enough cash around, right? So this is this finding. So we have this treatment where we lower the cash to asset ratio, which just means we have liquidity constraints in the model. So we just give some cash to the participants, and this is enough to reduce the number of bubbles. I mean, then if there is not so much cash, so that the ones who want to buy assets also at higher prices, if they don't have this cash to buy over and over again, then we don't get these repeated bubbles.
Yeah, so basically just saying more discretionary cash, more bubbles. Now, let's try and clarify. I guess a bubble would be a departure from what we assume to be the fundamental asset value with I don't know whether violent is the right term, but an unstable departure in return. And
right, so I mean, it's always a bit arbitrary what one wants to define as a bubble. I mean, is it a bubble if it goes to twice the fundamental value, if it's on average above twice the fundamental value, if it goes above 3 times the fundamental for several periods? I mean, it's a bit arbitrary, but I think so. The bubbles we find, it doesn't matter where exactly you set this threshold, right? So I think we all agree that if prices rise to 4 or 5 times the fundamental value, that's a bubble.
Yeah, well, this is such a topic here over in the United States that we always hear about. We think, are we in a bubble? We think these price to earning ratios are at record highs, and they seem to have been that way for a while. And is this just a permanent change? Who knows, right? So your research, which is in the Review of Financial Studies, is somewhat agnostic as to the current matters of the day. Is that the case?
Right. So this is really basic research about fundamental understanding of how people deal with such decisions in such simple financial markets.
And so the novel or interesting element which you've contributed to the discussion here, which your research has found, is that bubbles do remain if there is sufficient cash to asset. There is a sufficient cash to asset ratio, and you say you're actually surprised that other testers or experimenters have not considered this ingredient.
Right. So this is one main contribution of the article. Another, looking at why do we have these differences? A bit trying what does drive the bubbles? we provide a theoretical framework in explaining this, where we show that trend following behavior is really key for these bubbles to arise, right? So I think this is a neat explanation going further about only like the background of the market, also going to what's going on in people's minds maybe when they make these decisions. And I think we have some nice evidence that this is really about trend following behavior. And this is something. Oh yeah, please go ahead.
Yeah, this is what I was thinking, because again, you refer to trend following, but this academic research tries to be, let's say, conservative and not make speculation beyond what the actual evidence shows. And so, but we're going to speculate a little bit today, so we can be a bit more interesting. But you write here, quote, "Bubbles do not disappear with experience in our experiments." Okay. However, you mention in the piece that they can get quicker, right? Or change shape to some degree. Do they ever invert, where it might be that people have learned so much that they go the opposite way, that they basically overcompensate? No.
So we don't observe this. We don't observe this at all.
So is this really a nod to, what is it called now? Behavioral economics or behavioral finance, where you say this trend following is somewhat, I'm not sure what the fallacy is called or the bias is called, where we basically behave in a herd-like manner. That is what you're pointing to, correct?
I mean, right. So this is, herding and trend following behavior, they're very closely related, right? And I mean, there are several parts of behavioral finance and behavioral economics where it has already been shown that trend following plays a role in people's behavior. So, and I think what we show in our model is that trend following behavior is absolutely crucial. And what happens when you have more sophisticated people, you actually get these bubbles to speed up rather than to disappear. So they happen earlier in later repetitions. And so trying to put this intuitively, so let me try to get this in a very simple way. It just means that if you have some people who are trend following and others are maybe they might be very sophisticated. They might be able to calculate fundamental values and everything, but they know others are trend following. So they're trying to be a bit faster than the others, than the trend followers. So the sophisticated ones actually drive up the bubbles faster. Am I being too quick or too complicated?
No, that is, I just find this delicious, so fascinating, the way that even if you're this brilliant man who just says, I have no biases, I've removed myself from it, everyone else has biases, so you're going to still basically respond to that. And if you're smart, I guess you would try to be quicker and beat the biases. And that's what you're observing, that the bubbles are still there. They just maybe happen at a faster rate because we know we get accustomed to them and we get ready for them. Man, now, and one of the important points you make is that, in your experimentation, your modeling and experimentation, the information is very clear, but especially in financial markets in general, information is so messy, right? I mean, of course, with blue chip stocks, it's a bit simpler, but especially when you get down to small cap, and in our case, we deal with a lot of these mining or exploration companies where they have no cash flow at all, right? They're just spending and exploring. So the tendency towards this trend following or herd behavior seems to me to be much greater than you would even observe in your experiments. And so how would you transfer this information? I mean, one of the good things about this is that it's actually readable to a financial professional. What takeaways would you give to people who are financial professionals, portfolio managers, investors, whatever have you, when they look at this and think, does this just mean bubbles are going to be here forever and I've got to be quicker?
Well, it's hard. I mean, it's hard to transfer this like one-to-one I mean, what I would say, but many people know this already. This is like, I mean, don't buy into this everyone is rational hypothesis, right?
Oh, sure.
I mean,
sure.
you know, like certainly don't believe that all these prices are necessarily right in a classic rational sense. Many people know this, right? So then I would also say, I mean, be aware how strong trend following behavior is among humans. So I think that we can observe this, I mean, with students, with smart people with very simple assets in such a simple environment. Given that, it's most likely also very prevalent in the real world. I mean, this is how people make decisions, and if there are other smarter people in there, this doesn't mean that prices get back to fundamentals sooner. This can even mean that the bubbles rise faster and even then burst faster when they do burst. So this is a bit maybe the story as.
The Gold Newsletter is proudly sponsored by Inventa Capital Corporation, a venture capital advisory firm dedicated to the acquisition and development of assets in the natural resource sector. Today, Inventa is one of the premier mining groups with a first-rate portfolio of companies and a world-class team.
Hi, this is Brian London speaking again with you with our CEO interview this week on the podcast. We're speaking, of course, with the CEO of one of the companies in the Inventa Capital Group, which is the sponsor of the Gold Newsletter podcast. I'm speaking with you from my camp up in the woods because I wanted to schedule a very quick catch up with Charles Funk again. We just talked with him yesterday. Charles is not yesterday, but last week. Charles is the CEO of Heliostar, and in our last talk, he kind of prefaced that there's a lot of news coming up now after some pauses in drilling or drill results. There's a lot coming through right now. There was one news release for which we scheduled this call, talking about a porphyry discovery that you've made. Yet just before we got on air here, just a couple hours ago, you released more news from the Aquila vein. Catch us up, if you will, on all of the news flow that we've gotten just over the past few days.
Yeah, it's been a busy week for us. The most exciting is we're continuing to deliver on these high grade veins, and that's this morning's release on Aquila. And we've now got nearly 500 meters of strike with two real centers of gold mineralization, particularly 4 holes continue where each hole hit one after another on the northeast end is pretty exciting, and a high grade vein surrounded by a broad lower grade, which is something new.
Yeah, that's what I wanted to point out. We're used to getting the significant high grade intercepts, and really some amazing intercepts so far from the Unga project and the many targets that you're drilling on the Unga project. But this was something new. It was broad intervals of open pitable grade, lower grade, but still open pitable grade. And that seems to open up an entirely new possibility for the company of getting this kind of bulk tonnage targets. It is vein hosted, or that has been the target so far. So are you getting the kinds of widths now there that you do open up that potential for some open cut mining?
Yeah, I think that's what, we're early and we've got a lot more drilling, but that's what these results suggest is possible, in that you've still got the high grade vein, but the two best holes from today, nearly 20 meters at 1.8 grams, and then the next one 40 meters at 0.5. So you've got these really broad halos around that narrow high grade. The nice thing from our perspective about Aquila is we think there's two ways to win. You could have that classic high-grade shoot forming. You could also have this halo of multiple veins intersecting in a bulk tonnage target. So it's always nice to have two chances of success on a target.
Yeah, and if you do have that high grade in the center, that essentially helps raise the grade of an open pit and helps that pay back very quickly. So that's very exciting. Now to the porphyry target. That reinforces a couple of things for me. One, that there are a lot of targets on the Unga project. It's a very large project. there's been a lot of work done previously, but always kind of in fits and starts. So you have a lot of indications around the property, around the very large property, of other targets. Following up on one of them, you've discovered an entirely new style of mineralization. And of course, porphyry targets are typically very large. If they end up being an economic target, they are very large and very expensive to drill. Is that something that was in your initial mission plan, as it were, as a company? And how do you address that, considering you've been really targeting high-grade, discrete mineralization so far?
Yeah, and that's the approach that we think's different to what any previous explorer in this part of the world. There's two things we think we bring. One is we've drilled as many meters in 12 months as this project's seen in 30 years. So first of all, we're actually getting on with the job. The second part is all that drilling was on the resource. And as high grade as it is, what we think is that there's a district play. Like the project's twice the size of Manhattan Island. So this year, we said, let's test these other ones. Apollo, we talked about the great results. We've just touched on Aquila. We've worked up all these other targets in the background, either moving the prospects to drill ready, the drill ready to drilled, or the framework drilling into hopefully next year, what might be resource drilling. And so Zachary Bay, the porphyry target, was just one we thought, let's put a couple of holes in. It looks pretty interesting. Most of our holes are still in our focus is the high grade veins, but you couldn't ignore a target that good. And so, over big step outs, the whole holes are mineralized. They average about 0.4 gold equivalent, but there's local zones up to 0.7. And so that's what's got our attention. If there's these high grade zones in the porphyry, that would be a pretty attractive add-on, or potentially even sort of base load to support the high grade veins. So we're all about optionality, and the more ways we have to be successful, both from a share price perspective, but ultimately from a mine option perspective, it's worth doing a little bit of work to expand that.
So the drilling, the two holes that you recently announced that kind of confirmed the porphyry discovery, you have since, or perhaps at the same time, did a geophysical survey that showed a really bullseye target there, and neither hole really hit that target, right? So you're going to be following up and going after that in search of that higher grade core?
Yeah, so it's actually some historic magnetic data that was collected in the 70s. So one hole was drilled in the porphyry in the 70s. So porphyries are vertical, and they tested it with a vertical hole. So it's a very poor way of working out where the best part might be. So we did those two holes because there's also lots of cover there. So it's not really easy to see where you are in the system. So just a couple of sort of scout holes to see what it looked like, and given how encouraging they are, there's definitely, the core of the magnetic high is a clear target for us next year. So the scout drilling couldn't have been more successful from a first pass perspective.
Well, looking at the targets you had, the many targets you have on the property, where are we now in the current drill program, given that the weather in Southwest Alaska means you can start work earlier and extend it longer than most other companies? What are the plans for the remainder of the year?
Yeah, so we've got more assays to come from Apollo and SH1 from the program we completed at the start of the summer. What we'd like to do next is drill over on our Centennial target. It's right next to the airport. And the cool thing about that is it's road accessible, and you can drill it any time of year. So to be able to drill in Alaska anytime you like is pretty rare. And we're really looking forward to that. It's an old resource, a flat-lying resource, again, with a bit of this sort of open pit potential. But what we think is it's fed by high-grade subvertical veins. And so that's going to be our clear target there. There's so many targets on this project that just don't have enough known about them. And our framework drilling is to learn the context and then come back next year with that systematic diamond drill program to see if we can add them to the resource. So step one, step two, a very methodical approach.
In Centennial, that resource is historical and not included in any of your published resource numbers, right?
Correct. So yeah, it's a non-compliant resource. It was about just over 200,000 ounces at 1.3 grams defined by Battle Mountain. But there's really been no work done on that now for 30 years. And so we think there's a high grade target. And so the cool thing from an exploration perspective, we know we're going to hit gold. It's just a matter of how much and what grade. So again, another one of these really high probability targets that UNGA's got that makes it unique as an opportunity.
Yeah, the theme that I keep coming back on in this business, and it's not so much discovery as rediscovery, and that Sentinel resource, then if you could bring that into compliance, another couple 100,000 ounces right off the bat would help. Which brings us to what the final point I'd like to make today is that you have a resource at SH1 that's nearly 400,000 ounces at nearly 14 grams per ton. That's just phenomenal grades. And at that size, at that grade, I would think that it would be economic at some level already. That said, that resource is probably worth, in my estimation at least, a good bit more than your current market cap after this months-long malaise we've had in the metals and mining markets. So this is an extraordinary opportunity in that everything else you're finding right now, news release after news release, with all this following up on identified high-grade gold sources, high-grade gold targets, and now bulk tonnage targets. All of this is really just the cherry on top of a company that is already undervalued on the basis of its current high-grade resource. So Charles, really looking forward to the news coming up. It seems it's coming out in a rapid fire fashion. I hope we can get this video out before you have your next news release. But so we'll put a rush on it before it gets out of date. But I encourage everyone to look at Heliostar Metals, HSTR, on the Toronto Venture Exchange. News coming out one after another. The news releases are coming out, and lots more to be found here. Thanks again, Charles. Great talking with you.
Thank you very much, Brian.
Yeah, I mean, I like the story. I think it's relevant. And I read all these financial newsletters, and it's taken so much content, and there's obviously, as you say, there's maybe a canyon between the popular financial content and then the academic, because the academic obviously is so mathematically rigorous, whereas the popular, nobody wants to read mathematics. So it's just, I mean, there'll be references to a few metrics, but in general, people tell the story of the management and the history of the company and all these things, which don't really tell you whether the price is right. I mean, it's helpful information, but it doesn't really get to the nuts and bolts of, is this price really reflective of the future cash flows? And is the discount rate selected correctly? All these other details. And so that my sense is that you're touching upon, you've struck a nerve basically that is just pervasive, right? And we've had another finance and statistics professor on here who has written a book about, I guess, the challenges or the evolution of the efficient market hypothesis and why it became so popular and prevalent. Of course, it seems to be somewhat breaking down, being not so believed just universally, that we're having a more nuanced understanding of that perspective these days. Now, so given how much I'm reading here, given how much more complicated markets outside the laboratory are and how much wealth there is enabling bubbles to form, it is likely that prices in actual markets can deviate substantially from fundamentals, no matter how experienced the traders are. Now, you could say, though, that one of the biggest, there are two major trends we've observed in the last decade or so. Enormously greater information, right? We have much more information at our fingertips. And second, we have I'm not sure about Switzerland, but we have a much broader participation in stock markets, and not just regular stocks, but bonds and everything in the United States. Now, so we have, more information. So I guess, are these pulling in different directions in terms of bubbles, that the more information we might say would speed these up or maybe lessen them, but a broader participation of people? Do you think people in general be more inclined to bubble-like behavior than the professionals?
So that's the thing. I mean, these are two interesting questions you raised. So one is like, does the degree of information we have matter, or in how much does it matter? And I think our paper is a bit of a cautionary tale, because so I mean, you read this. We also have these information treatments where we provide different degrees of information, and we find that this doesn't matter so much, because what's really driving the results here is this trend following behavior, and maybe others who anticipate trend following. So if we can find an analogy in the real world here, or if we can transfer this to the real world, this would mean so much information doesn't even make a difference, because people will not necessarily calculate the fundamentals with this additional information, but they might still rely on, well, the sophisticated ones are trying to predict what the others do, and the more simpler investors are going to be trend followers. Right, so the more information does not necessarily make the markets more stable. And I think if we look at markets in the past, I mean, in the very recent past, we haven't seen that they are somehow less volatile or something with this additional information, right?
Yeah, it's an important point that you're right, that we have not experienced more stability with this proliferation of information. And a question that was posed to me and my fellow students at Rice University in Texas was, how do you actually assess the performance, let's say, of an asset manager? Or here in the United States, you'll have registered investment advisors. And the truth is that very few people really go by the numbers. In general, they go by, did he shake my hand well? Do I know his friends? And that's just, like I said, that's just these are the biases that humans have. And that's why I think I obviously, I think your paper is touching on something so important. And I'm shocked to some degree that previous academic work, do you want to clarify how strongly has it come down on the side that humans basically learn from experience, and that will in general soften or ease away, dissipate the bubbles over time?
Well, I mean, so this is what's been found in several earlier papers, right? Now, these papers, I mean, so
we're not saying that people are foolish or anything like that. We're not trying to demean people. We're just saying that the not consensus, but the rising tide prior to this paper has been more suggestive of rationality, as you say, and learning from experience. And that's what you're pushing back on with your research.
Especially learning from experience, right? So rationality, yes and no, because these bubbles in the first round, so in the first markets, they've been found persistently. Then it's the learning with experience that we've had in these past experiments with these lower cash to asset ratios. So where this difference is. And then I think it's up to these papers a bit, or it's up to interpretation, whether you say, well, people are not so rational, but at least they can learn in such a simple environment, or whether you say, well, we have some quite rational learning here. So they are basically rational with some mistakes in the beginning. I mean, this is just a matter of
it's semantics to some degree. Yeah, because the challenge, as you say, is that even if you are brilliantly rational, but everyone else is irrational, at what point do you all just make the switch to being rational, to sort of not being herd-like or not anticipating herd-like behavior? You'd have to get to a very high threshold of everyone observing the herd-like behavior and trying to beat it, and then suddenly the herd-like behavior is basically eliminated. And so, yeah, we should not get tied up in irrational versus rational. It's just the way we behave and understand others and respond to other behavior. That's really the challenge. So, okay, this article, which we'll post at the Gold Newsletter podcast archive, is goldnewsletter.com/podcast. And we will include a link to Matthias's Twitter and to his personal website. And he's got lots of other work going on. you had maybe, I'm trying to think, maybe a dozen implications from this research. Are there any in particular that you think you'd just like to share that I've not pushed upon in this half hour?
No, I think so. So, this importance of cash being around, of the availability of means to buy assets, we've talked about that. And I think the importance of trend following behavior, we've talked about that. And that actually more sophisticated people then don't go for the fundamental value, but that they actually make this trend extrapolation even stronger. So we've had this. So I think I left one question open from you. So you posed two questions earlier on. One on the participation, whether this matters, right? So you said that one I haven't answered yet. So more people going in the markets, and here it's not so clear. So I think this is also something that one should not necessarily worry about markets becoming less stable if a lot of people maybe that don't know much about finance enter the market, because it's not clear whether it's worse to have people that then behave like trend followers, or whether it's worse to have more people in there that are trying to be extra fast in exploiting trend following behavior by others. Right? So that's
it's not clear. It's not
clear.
I mean, one thing, of course, as economists, we want to believe that markets facilitate allocative efficiency, and that's what the real fundamental value should be signaling, that this is where the most value is. And in terms of resource allocation, that's the smarter or superior way to go, but nothing is optimal, I guess. Now, the trend, particularly here in the United States, of a much broader decentralized participation is clear. And I'm just reading too about how, for example, the mutual funds are struggling, right? The mutual funds are going down, being replaced by ETFs, which means more and more just individual investors. Now, that would suggest, though, that this cash to asset ratio will get higher, that there'll be more and more people bringing their cash to the table to engage in this, or more cash accessible. So that would even accentuate the bubble behavior. So we can expect more of this to come. Maybe. Am I interpreting this
possibly
correctly?
Right. So I mean, if there is more money around that's being invested, that would indeed make it more likely to have more bubbles. Yeah.
Well, not only just more money around, but in general, as just humanity becomes wealthier, right? We have more discretionary income, so less devoted to the basic needs, basic necessities, and more available to speculation. Right, man. Okay, so, and I'll just give a side note that I traveled to the University of St. Gallen a couple of years ago, and it's a gorgeous spot. If people are looking at business schools, you should check it out. Lovely, lovely location right by the Swiss Alps and right near Liechtenstein as well. So anyway, that's a side story. University of St. Gallen, HSG, I think is the German abbreviation.
Right.
Okay, Matthias Weber, thanks for your time, mate. I really appreciate it, and I hope people read your paper.
Thanks very much for having me.
Cheers, man.